Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, November 11th, 2025. As always, we'll start with the executive summary from today's lead-off morning note. So let's hop right in. Today's key macro question is, the shutdown is ending. Why aren't risk assets appreciating? The short answer is because as long as we've maintained, the U.S. federal government shutdown is a sideshow compared to the Powell Fed's latest policy mistake. In terms of the analytical nuance, the historic 42-day U.S. shutdown is poised to conclude as early as Wednesday, after the Senate approved a temporary spending bill funding most federal operations through January 30th and select agencies through September 30th. House Speaker Mike Johnson expects swift passage in his chamber. Once enacted, the measure heads to President Trump, who has already endorsed it. After its strongest session since May, Mag 7 stocks are dragging indices lower as SoftBank Group offloaded its entire $5.8 billion NVIDIA stake to fund other AI ventures, sending the chipmaker down 3% Tuesday. Treasury futures climbed and the dollar weakened after ADP research data signaled a sharper labor market deterioration in the second half of October, with traders turning to private data sets as the ongoing government shutdown delays official economic releases. According to ADP research, U.S. companies cut an average of 11,250 jobs per week during the 4 weeks ending October 25th. This compares to its latest monthly report, which showed ADP private payrolls rising 42,000 in October after back-to-back declines. Elsewhere, Bloomberg data show corporate mentions of economic slowdown and synonyms during earnings calls have fallen to their lowest level since 2007 in Q3. Similarly, media coverage mirrors this optimism, as references to the economic slowdown in Bloomberg news articles dropped to their lowest level since June 2021. This positive data represents the top of the K-shaped U.S. economy and stands in stark contrast to the October NFIB Small Business Optimism Survey results, which featured a further deterioration in this critical subset of the U.S. economy. Recall that small businesses account for 3/5 to 2/3 of employment growth. This suggests the incremental deterioration in small business sales, profit, and hiring expectations is likely to weigh on subsequent jobs reports and signal to the tardy Powell Fed that it has made yet another policy mistake in a tenure littered with them. For what it's worth, in 2013, when the prior shutdown affected the jobs report, the government reopened on October 17th and released the September employment data 5 days later. That suggests the September jobs report is likely to be reported sometime next week. As always, members of our global investor community can trust that our institutional grade risk management overlays, KISS and Dr. Mo, will help our portfolios navigate these emergent risks better than investors attempting to manage risk without systematic rules or relying on fundamental research alone. So as always, we'll wrap up with the question from our global investor community here in our 42 macro dashboard. So this one's titled, where will the 7.5 trillion sitting in money market funds go as the rate cuts continue? It says, hi, Skipper. Give a fundamental point of view on the 7.5 trillion currently sitting in money market funds. Specifically, do you expect this will draw down as the cutting cycle continues? And if so, where is that money most likely to go? So rather than answer that with words, let me just go to my Bloomberg charts. Got a chart here, graph number 868 out of 1,800 charts in 4.5 years. That's what it takes to stay on the right side of market risk, folks. So this chart here shows the blue line in the top panel shows the ICI money market fund assets, $7.5 trillion. The red line shows Bloomberg stock market cap, U.S. equity stock market capitalization, and the bottom panel just shows the ratio of money market fund assets to the U.S. equity market capitalization. And so a couple of points I'll make on this. One, we are at a historically, not historically low, but a cyclically low level, cyclically and structurally low level in terms of the ratio of money market fund assets to U.S. equity market cap. Specifically, we're in the 25th percentile of daily data going back to 2003, which is as far back as we can have the time series for the equity market capitalization data. Second, the most important point I would make is the blue line in the chart in the top panel, which is the nominal value for the money market fund assets. There's only 2 times in this time series, and in fact, I actually have data going back to the 70s for this and can confirm the only time the money market fund assets declines on a durable basis is coming out of recession. So you typically see a mad dash for cash heading into the recession, and then ultimately that cash is redeployed after the recession. This is Wall Street, doing a reasonably decent enough job managing risk. So the key takeaway here is you should not expect the cash on the sidelines, the money on the sidelines, to ever sort of be used as fodder to capitalize asset markets when they're at their highs. They will eventually be used as capitalized asset markets when the markets are at their lows, at their post-crash lows. But the reality is, it's not a bull cat. Money market fund assets historically is not a bull catalyst. When markets are at their highs, it's more likely that we see an acceleration in the accumulation of money market fund assets, particularly once the subsequent bear market starts. That's obviously when the markets are done pricing in our bullish paradigm theme, which we've maintained since April. So we'll wrap it up there. Darius still here presenting our macro minute for Tuesday, November 11th, 2025. Best of luck out there today. We'll catch you back here tomorrow, and happy Veterans Day to all of our military family and friends on Team 42. We appreciate you. Thank you for your service, and God bless each and every one of you. Cheers.